Warren Buffett is the person who would take your money and turn it into $1 billion. Yes, he would do it in 5 or maybe 10 years, but he can still do it. There are many bad investors out there, and Warren definitely is not one of them. His methods are different, but he is nothing but successful. But what are the secrets to his success? Don't worry, we will tell you all about it in this video. And of course, you can always subscribe to our channel, Education Investor, for more videos like this. If you already did, let's just get into it. Warren Buffett, a brief history. Warren Buffett was born in Omaha in 1930. From an early age, he was interested in business and investing, including the stock market. Buffett began his education at the Wharton School of the College of Pennsylvania before returning to the College of Nebraska, where he earned a bachelor's degree in business administration. Buffett later went to Columbia Business School, where he earned a degree in economics. Buffett began his career in the early 1950s as an investment salesman and founded Buffett Associates in 1956. Less than 10 years later, in 1965, he took control of Berkshire Hathaway. In June 2006, Buffett announced plans to donate all of his assets to charity. In 2010, Buffett and Bill Gates announced that they had launched the Giving Pledge campaign to encourage other high-net-worth individuals to engage in philanthropy. Buffett's investment philosophy. Buffett follows the Benjamin Graham school of value investing. Value investors look for securities whose prices are unjustifiably low when measured against their intrinsic value. There is no universal method for determining intrinsic value, but it is usually determined by analyzing a company's fundamentals. Like bargain hunters, value investors look for stocks that are considered undervalued by the market, or stocks that are valuable but not recognized by the majority of other buyers. Buffett takes his value investing approach to another level. Many value investors reject the efficient market hypothesis. This theory holds that stock always trade at fair value, making it difficult for investors to either buy stocks that are undervalued or sell them at inflated prices. They trust that the market will eventually begin to favor the quality stocks that have been undervalued for a while. Warren Buffett has always stressed the importance of investing in yourself to be successful. This includes making prudent financial decisions and expanding one's knowledge in the areas in which one wants to be involved. Buffett, however, does not care about the intricacies of supply and demand in the stock market. In fact, he is not at all interested in the activities of the stock market at all. This is evident from his famous paraphrase of Benjamin Graham's quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." He looks at each company as a whole and therefore selects stocks based solely on their overall potential as a business. Because Buffett holds these stocks for the long term, he does not seek capital gains, but rather holdings in quality companies that are capable of generating earnings. When Buffett invests in a company, he is not concerned with whether the market will eventually recognize its value. He is concerned with how well that company can make money as a business. Buffett's methodology. Warren Buffett finds good value by asking himself a few questions when evaluating the relationship between a stock's level of excellence and its price. Note that these are not the only things he analyzes, but rather a brief summary of what he looks for in his 6-step investment approach. Number 1. Company performance. Sometimes return on equity is also referred to as shareholder return on capital. It indicates the extent to which shareholders are earning returns on their shares. Buffett always looks at ROE to see if a company has consistently performed well compared to other companies in the same industry. ROE is similarly just like this. ROE equals to net income divided by equity. It is not enough to just look at last year's ROE. The investor should look at ROE for the last 5 to 10 years to analyze historical performance. Number 2. Debt of the company. The debt-to-equity ratio is another important characteristic that Buffett carefully examines. Buffett prefers a low debt-to-equity ratio so that earnings growth is generated from equity rather than borrowed money. The debt-to-equity ratio is calculated as follows: total liabilities divided by equity. The ratio shows the ratio of equity to debt that the company uses to finance its assets, and the higher the ratio, the more debt, rather than equity, the company is financing. A high debt-to-equity ratio can lead to volatile earnings and high interest expense. For a more rigorous test, investors sometimes use only long-term debt instead of total liabilities in the above calculation. Number 3. Profit margins. A company's profitability depends on not only having a good profit margin, but also on continually increasing it. This margin is calculated by dividing net profit by net sales. To get a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates that the company is executing its business well, but increasing profit margin means that management has been extremely efficient and successful in controlling expenses. Number 4 is the company publicly traded. Buffett usually only considers companies that have been around for at least 10 years. Therefore, most technology companies that have gone public in the last decade would not be on Buffett's radar. He has said that he does not understand the mechanics behind many of today's technology companies and only invests in companies that he fully understands. Value investing requires identifying companies that have stood the test of time but are currently undervalued. Value investing focuses on a company's financials as opposed to technical investing, which looks at a stock's price and volume and its historical performance. Never underestimate the value of historical performance. It shows the company's ability or inability to grow shareholder value. Keep in mind, however, that a stock's past performance is no guarantee of future performance. The value investor's job is to determine how well the company can perform in the future. Determining this is inherently difficult, but clearly Buffett is very good at it. Number 5. Dependence on commodities. At first glance, one might think that this question is a radical approach to narrowing down a company. However, Buffett sees this question as important. He tends to avoid, but not always, companies whose products are no different from those of their competitors, and companies that are solely dependent on a commodity such as oil and gas. If the company offers nothing that is different from another company in the same industry, Buffett sees little that sets the company apart. Any characteristic that is difficult to mimic is what Buffett calls a company's economic moat or competitive advantage. The wider the moat, the harder it is for a competitor to gain market share. Number 6. Is it cheap? This is the crux of the matter. Finding companies that meet the other 5 criteria is one thing, but determining whether they are undervalued is the hardest part of value investing, and it's Buffett's most important skill. To verify this, an investor must determine a company's intrinsic value by analyzing a range of business fundamentals, such as earnings, revenues, and assets. And a company's intrinsic value is usually higher and more complicated than its liquidation value, which indicates what a company will be worth if it were broken up and sold today. Liquidation value does not take into account intangible assets, such as the value of a brand name, which is not directly reported in financial statements. Once Buffett determines the intrinsic value of the company as a whole, he compares it to the market capitalization, the current total value or price. Sounds simple, doesn't it? Well, Buffett's success, however, depends on his unmatched ability to accurately determine that intrinsic value. While we can outline some of his criteria, we do not know exactly how he achieved such a precise calculation of value. And with that, you actually know all you can about this great topic. For more videos, you can always subscribe to our channel, and we would love to see you in the next video. Until then, have a great day and goodbye.